recording. Okay, so I just wanted to show you one little
that
thing.
wasn't recorded. I was hoping what you had just done was recorded.
No,
Well,
yeah, I didn't think to start it at that point. Sorry. It's because I'm a terrible person.
no.
You don't know. You don't know me. You don't know my life. Let's see. So let me go over a couple of things here, and then I can maybe try to address any questions you might have. So this chapter is, they call it long-lived assets, which I guess that's what we're talking about, is assets that don't get used up in the short term. So that typically means assets that we are going to keep for a year or more. And that includes things like land and equipment and automobiles and buildings and things like that. So the first question people have, so when we have an asset like that, we are going to record depreciation on the assets. And depreciation, we've already been exposed to or introduced to the concept of depreciation. And it's easy to sort of believe that depreciation is the means by which we show the value of something going down over time. But that's not really what we're doing, because some assets that we depreciate might not be losing value. Some buildings might become more valuable over time. So what depreciation is it's the process by which we allocate the cost of an asset to expenses over the asset's useful life. So the idea is, if I buy a building, so I own a storage facility. If I buy a new building and I spend $40,000 on that building, I can't just take the expense of the building right now, the whole $40,000, because that building is going to actually be an asset I use to generate revenue for the next 30 years. So instead, what I have to do is spread the cost of the asset out over the next 30 years and recognize a portion of it as an expense over the next 30 years. And that's what depreciation is. It's the process of recognizing the cost of an asset as an expense over its useful life. So the first thing you have to do to be able to figure out depreciation is know how much an asset costs you. And that seems obvious. It's like, well, what I paid for it, but it could include other things. So not only what you actually paid for, like for me for the building, but anything like closing costs, like if I had to pay escrow fees or something like that when I purchased the building, commissions to a real estate broker, property taxes, and even things like any costs of sort of getting a building ready. So if I buy a building and I've got to do some repairs to it before it's ready to put into service and actually use, those costs of getting an asset ready to function, those are all part of their cost. So that's sort of an important thing to understand.
Can I, sorry,
That's okay.
You. But it's on this subject. I was under the impression that you don't include land improvements, but there is a question in the additional self-study, and it says that the land improvements must be included in the property, plant, and equipment classification. So it is included in the, like, you have to add that. So what am I missing?
Okay, so what we don't do is we don't add land improvements to the value of the land. So land is tracked separately from land improvements. And that's because land doesn't get depreciated. So we're not allowed to claim the expense or cost of land as an expense. And that's because land has an indefinite useful life, meaning a piece of land can be used forever, unless, of course, we ruin it somehow. Whereas land improvements, things like paving, sidewalks, fencing, those don't have an indefinite useful life. Those will get used up over the asset's lifetime. So we don't include land improvements as part of the land costs. Instead, we track them as a separate asset. Does that clarify or no?
Yes, it's just that in the exercise at the end of the meeting, like if you want to look at it, because I thought that I didn't add, but it apparently I had to add the land improvements to the total.
Okay, why don't we, so land improvements will be tracked as an asset. So maybe we'll look at that one in a minute. Let me go through the rest of this, and
Okay.
then we can look at the specific problems and see if we can clarify that.
Thank you.
So in this book, they will teach us 3 different depreciation methods. And those are the straight line method, the declining balance method, and the units of activity method. The vast majority, in like real life, the vast majority of assets we use the straight line method, mostly because the IRS makes it super easy. They put out a schedule, and so you can just look up the kind of asset. Like for mine, it's non-residential rental real estate. And if I just look it up, it says 39.5 years. And so that's the useful life I use. And I don't have to ever worry about in an audit someone questioning why I chose that useful life, because it's right on the IRS schedule. And so the vast majority of the time we use, it's called MACRS, M-A-C-R-S. It's the Modified Adjusted Cost Recovery System. But anyway, we use that, and that is done with a straight line. So I just want to kind of go through an example here of these 3 different methods. And I know you've probably already gotten into this a bit in your homework, but here's a business, Bill's Pizza. They purchased a delivery truck, cost them $13,000. They expect at the end of the truck's useful life, they'll be able to get $1,000 salvage value out of it. And then we know that the truck's estimated useful life is 5 years in years, and the estimated useful life is 100,000 miles in miles. And so to compute our depreciation, we can use all 3 of these methods. Let's see.
I think we have to know how to do them on the exam, or at least my tutor had to when he took the exam.
Know how to do what?
All 3 methods.
Right. So I'm going to kind of walk through those 3 methods quickly here. All right. So the first thing we have to do is figure out the depreciable cost, which is our cost minus our salvage value.
Is that also called book value? Or is that different?
Yeah, our book value is our cost minus accumulated depreciation.
Oh, that's right. That's right.
Yeah.
Okay.
So this is just the amount we're going to depreciate over the life of the asset, the depreciable cost. So what we paid for it minus any amount we think it will be worth at the end of its useful life. And then we just take, for straight line, we just take the depreciable cost and divide it by the useful life, and that gives us an amount. So if we do the useful life in years, then that'll give us the amount of depreciation expense to take per year. Every once in a while, you'll see a business that does depreciation expense monthly. All they would do then is, instead of dividing it by 5 years, they would divide it by 60 months, right? And it would come out with the monthly amount. Let's see. So here they're doing a this would be like a depreciation schedule. So again, it starts with a depreciable, the depreciable cost. And this is a little confusing. It says rate 20%. That's the same as saying 1/5, okay? Or in other words, they're depreciating it over 5 years. So it's the same as dividing it by 5, okay? 20% is the same as 1/5. So the depreciation expense then will be 20% or 1/5 of the $12,000. So we'll do $2,400 a year. And then each year, so in the first year, we recognize the expense of $2,400, and our accumulated depreciation that year will be $2,400. And our book value will be the cost, the total cost, the $13,000 minus the accumulated depreciation will be our book value.
So you're saying this if they give you a percentage rate to figure out?
No, they didn't give us a percentage rate. They said it had a 5-year useful life. I'm sorry that if I had written this out, I would have written just divide it by 5 for the 5 years in the useful life.
So they're doing 20% because
20% is 1/5.
is 1/5 of.
But it's confusing because
100.
it should just say divide by 5. But if you do 12,000 divided by 5, you're going to get 2,400. Or if you do 12,000 times 0.2, you'll also get 2,400. So I'm not a fan of how they wrote that. Anyway, for straight line depreciation, all we're going to do is take the depreciable cost, divide it by its life and useful year. That'll be the amount of depreciation per year. And so this is what they have set up here, $2,400 of depreciation each year. At the end of 1 year, cumulative depreciation will be 2,400. At the end of the second year, it'll be 4,800, etc. And then
Because that adds up.
Yeah, it accumulates, right? Yeah, so
okay.
And then our depreciation expense each year we'll just do a journal entry that looks like this: debit depreciation expense, credit accumulated depreciation.
So when we go ahead.
No, go ahead.
So when we do, so we always start the next year with the cost. We don't use the book value. So like say for example 2018, we don't start with 8,200.
Nope.
Start with 12,000.
Yep. Because this is straight line depreciation. So what that means is we're going to depreciate the same amount each year, which is always 1/5 for a 5-year asset, 1/5 of the value of the depreciable cost.
Matt went to the store for me.
So the schedule never changes?
Nope. I mean, correct. It does not change. We do the same amount each year with straight line.
No, I cannot help you right
Okay.
now.
Okay.
So that's the whole. I mean, I guess that's what makes straight line is the fact that we calculate the amount of depreciation and then.
I thought it was
Shut the door, please.
just the annual expense that wouldn't change. So for example, if you start
Correct.
with 12,000 and then the 2018, you'll have 8,200 minus 2,400. So well, I guess.
Well, so you're thinking of the book value. Okay, see, it does go
Right.
down. So the only thing that's changing here is the accumulated depreciation is going up by 2,400 per year, and the book value is going down by 2,400 per year.
Okay. Okay.
Sometimes they'll show this where they take the book value and then they carry it over to the front to the next year, and then subtract 2,400.
Yes, that's what I'm.
Okay, but as far as the calculation of the amount of expense, we're always going to use the depreciable cost.
Okay.
In straight line.
All right. Yeah, that makes sense. And I'm just looking at it, made me really confused because I
Yeah,
thought
no,
it was
like I said, after I looked at this more, I said I don't like the way they wrote this out because it looks like we're doing something different. And so this is a method we've used already. Okay, so like even when they introduced the idea of depreciation, this is what we used is straight line. We just divide the depreciable cost by the useful life. So the second one is more complex. So before I go to the second one, so we'll see this one is a partial year straight line method, so that in the first year they didn't start until April, so they're going to depreciate 9 months worth of that $2,400 on the first year, and then 3 months on the last year. So you still end up depreciating the whole $12,000, but you can have partial years. What?
Well, I'm just trying to picture that problem as a word problem, like you know, they give you this information and they want you to figure that out.
Janet.
I'm trying to picture it as a word problem.
there's many problems in the self-tests for this
Okay.
on the straight line.
Right.
They're like
Okay.
Yeah.
All right.
Just recognize that we don't always, like, if we purchase an asset on April 1st, we wouldn't do a full $2,400 worth of depreciation for that first year. We would just do April through December in the first year, which is 9 months. And so we would just take the 1 year rate, the 2,400, or the 1 year amount, 2,400, and then multiply it by 9/12 to get 9 months worth of it. That's all that's
Okay.
different from what we showed at first. So the declining balance method is an accelerated method. It sort of recognizes that we are going to take as an expense a larger portion of an asset's value up front, and then use the declining balance to take the rest of the depreciation over time. And so what we do here is well, let me just show you. All right. So what you do, this is called the double declining balance method, is you take the straight line rate. So if it's a 5-year asset, then that would be depreciating 20% of the asset's value per year. And then we double it. That's the double for the double declining balance. So we take and here we're actually going to use the balance or the book value of the asset to figure out the amount of depreciation expense each year. So in the first year.
So for declining balance, we don't subtract anything from the.
Correct.
Oh,
So,
we use the book value. Okay.
Right. We don't subtract the
salvage.
Yeah, the salvage value. So what we do is we take whatever the straight line rate would be and we double it. That's the first step. So you'll see that they have their rate here as 40%. And then in the first year, you take the book value, which is
How
the
did they
total
come
cost.
up with that?
With what?
With the 40%.
So most books that I teach this out of, they call this the double declining balance method. So you take your straight line amount. So remember, so if it's an asset that depreciates over 5 years, then what we would do as a straight line method is we would depreciate 20% or 1/5 of the asset value per year. If it was an asset that depreciated over 10 years, we would say that we would be doing 10% per year, and we'd double that to 20%. So it's just the double of the straight line depreciation rate.
So you need to find out what the straight line depreciation amount is going to be, and then you double that.
Yes.
Or you find the percentage.
What
and double the percentage.
Yeah, the rate. That's the rate, is the percentage. So
okay.
So
I have a problem that
okay. So just to find your straight line rate,
after this.
To find your straight line rate, just take 1 divided by the number of years in the asset's useful life. So if I have an asset,
okay,
that might help. So if I have an asset that has a 5-year useful life, I would just do 1 divided by 5, and I'd say that's the depreciation rate is 20% per year. If I have an asset with a 10-year useful life, I would just take 1 divided by 10, and I'd say the depreciation rate for that asset is 20% per year. So that's the straight line depreciation rate. Is
so you
1
just double that for declining.
For straight line, it's 1 divided by the useful life in years, and then for declining balance, we're going to double that.
And then is the same.
And then what?
And then the rate remains the same?
Correct. The rate remains the same throughout the process. So let me walk you through the process. So in this case, it's a 5-year asset. So the straight line depreciation rate would be 20%. We double it to 40% for the declining balance method. We take our book value, multiply it by 40%. That gives us our depreciation expense. That gives us our depreciation expense of $5,200. And since it's the first year, our accumulated depreciation will also be the same as our depreciation expense that year. Our book value will be the beginning book value minus the accumulated depreciation. So our new book value will be 7,600. We carry that over. Wait, that's weird. They made an error. That's going to confuse you more.
They made it 7,800 instead
It should
of
just
7,000.
carry over exactly. So this 7,800
is wrong.
no, actually the 7,600 is the error, right? 13,000 minus 5,200 should be 7,800.
So that's
All right, sorry about that.
okay. One of them was the error.
Yeah. So now for the second year, to figure out the amount of depreciation, we take the beginning book value, multiply it by the rate, 40%, and that gives us $3,120 in depreciation that year. Our accumulated depreciation will be the previous year's accumulated depreciation plus this year's depreciation, 8320. And then our new book value will be the original cost minus the accumulated depreciation will be our book value.
Okay.
So book value is always the cost minus the accumulated depreciation. For year 3, we take the book value, multiply it by the rate. That gives us the amount of depreciation. Then we add last year's accumulated to this year's, it gives us our total accumulated depreciation. And our book value will be the original cost, 13,000 minus the accumulated depreciation. It will now be 2,808. Year 4, take 2,808 times 40% to get the depreciation for the year. Add to last year's accumulated depreciation to get our total accumulated depreciation. Subtract that from the original cost of 13,000 to get the book value. In the 5th year, or the last year of the asset's useful life, we don't worry about the rate anymore. Instead, we say, oh yeah, there was a salvage value of $1,000. So I'm going to take this book value and I'm going to subtract whatever I have to from it so that it ends up being $1,000 at the end of its useful life. So 1685, I'm just going to say depreciate 685 in this last year, which will make my accumulated depreciation plus 685 will make a total of 12,000. And then my book value is my original cost minus the $12,000. So in this method, what we end up doing is taking a larger portion of the expense in the early years of the asset's life. We good with the process there?
Sort of. This
So
one
what
is
was the
a little bit more complicated than the other one.
Correct. And it's partially the reason why it's just not used that often, just because it's more complicated. And because the IRS, there's more places for the IRS to question you if you use this method. Like they'll say, why did you use a double declining balance instead of a 1.5? Because they also, you can do a 1.5, and so instead of 40% rate, you would do on a 5-year asset, you would do a 30%. And so there's just more things for them to question because it's more complicated. So that's why people don't use it very often.
I think I'd rather use a straight line. It looks less complicated.
Yeah, because for straight line, what you do is you look up in the IRS book what the life of the asset is. Then you figure out, you take the cost of the asset minus salvage value and divide it by that useful life. And then you never have to calculate it again. You just take that depreciation expense at the end of each year for the rest of the asset's useful life. Easy, right? Here I've got to figure out what my 1-year rate is, double it, and then go through this whole process for each year. Still though, your journal entry always looks the same. It's a debit depreciation expense and a credit to accumulated depreciation. That's always the same. The next slide just shows us that the same thing could happen where they do a partial year on that first year and then a partial year at the end. Again, that's just know that not all assets start their useful life on January 1st. That'd be nice if they did, but we buy things the other 364 days of the year. So we have to be prepared to calculate a partial year. And then the units of activity method is very similar to the straight line method, but instead of using years as the basis for depreciating the asset, we use the units of activity. So for a vehicle, it might be the miles it's driven, or for a piece of equipment, it might be the number of machine hours it's run, or something like that. So what you do is you take the depreciable cost, which again is the cost minus salvage value, divide that by the total units of activity. For this vehicle, it was 100,000 miles. And then that gives us a depreciation cost per unit, in this case, per mile. So every mile that the truck drives, they're going to depreciate 12 cents. And then just each year, you look at how much activity there was during the year, and that tells you how much depreciation expense to do. So here we see this truck was driven 15,000 miles in 2017. Multiply that by the rate of 12 cents per mile.
That's something they would give you, the 12 cents a mile?
No, I just showed you how to figure that out.
I went.
So you take your
Oh,
depreciable
okay.
cost, divide it by the total units of activity in the asset's useful life, and that gives you a
Gotcha.
depreciation cost per unit. All right. So we just take the miles driven times the rate per mile. That'll give us the amount of the expense. Again, in the first year, your annual expense, depreciation expense, always equals your accumulated depreciation. And then your book value is your total cost minus accumulated depreciation. In the second year, this one year they drove at 30,000 miles, so they'll depreciate $3,600. Add last year's accumulated depreciation to any depreciation expense this year to get the new accumulated depreciation. Subtract that from the original cost to get the book value. Third year they drive at 20,000 miles times the rate per mile. They'll do 2,400 this year, add it, and so forth. And again, your journal entry is the same: debit depreciation expense, credit accumulated depreciation. And that's it for what I wanted to kind of go over. So maybe if we look at a couple of the problems, that will help solidify it instead of just being me giving you a speech. So Patricia, what was the one that you had said you wanted us to look at, or the couple of them that you had mentioned?
Yeah, it's the additional self-exam questions, and then it's the questions are 23 and 28 from chapter 9.
All right, let me get there. So I'm going to go to my announcements, and then I'm at home on my laptop today, so I only have one screen, and I've gotten spoiled, and I'm used to having multiple screens. It takes me longer to find stuff. All right, additional study content, chapter 10. And then self-test, additional self-test?
Yes.
Okay. All right, let me share my screen again.
And then it's 23 and 28.
Okay, so let's see. So Goggle Inc., not Google. Is this the one?
Actually, no.
No, because that's Bond.
Did I open the wrong one? Did I do the last chapter?
I think you did.
Yeah, you
chapter 8.
Chapter 10.
Hold on, I probably just clicked on the
10.
wrong one. Let's see.
Oh, this is 10.
Oh, I did. I went to chapter 10. Sorry, so additional self-test for chapter 9.
Additional or self-test? Which one was?
She said additional, right?
Okay.
All right, sorry about that. All right, now what was it again? 23?
Yes.
Okay. All right. So a company has the following asset account balances: buildings, accumulation, patents, land improvement, land. Is that the right one?
Yes.
Okay. How much will be reported on the balance sheet under property, plant, and equipment? Okay. So what we have to do is look at each of those and say which of those are property, plant, and equipment types of assets. And property, plant, and equipment includes land, buildings and equipment, land improvements, less any accumulated depreciation, but not patents, because patents are a different type of asset called an intangible asset.
But why does it include land improvements?
Because land improvements are part of our property, plant, and equipment.
Because it's on the balance sheet. It's not
Right.
saying how much
It's not asking us
the
whether or not we should
asset
add it to the land
is worth,
specifically, but we do
right?
add it to our property, plant, and equipment.
Oh, okay, okay.
Right.
Do you remember the place in the book where you read that or anything, so we can maybe make sure we like
What?
where you
No,
told me that
it's
you'd read
when you yeah, so when you rate, like when you submit the test, it gives you a description, like
Okay.
of what it means.
If you got it
So,
wrong or
yeah,
right, it tells
yeah,
you why it was wrong or why it was right.
Okay.
yeah.
Yeah. So I think the confusion is that it probably says somewhere that we do not include land improvements as part of the cost of the land. But
Yes.
but it maybe what's not clear is that we still include them as part of our property, plant, and equipment assets. Just it has to be tracked separately from the land.
Okay.
It's a lot of zeros. And then minus our accumulated depreciation. So I think it should be 14 million. It won't let us check like individual, or else we just check it. But what was the other one, Patricia?
28.
Yeah,
I think.
28.
28. So Schneider Trucking purchased a new semi truck for $200,000. Useful life expected to be 4 years. Salvage value 25,000. What is the depreciation for 2014 using the declining balance method at double the straight line rate? So what we're going to do is, first of all, we say, okay, if this asset has a 4-year useful life, its straight line rate is 25% per year, right? That's the amount that we would depreciate. So to double that, our depreciation rate is going to be 50% for the declining balance. So now I'm going to say, so the beginning book value of this asset is $200,000. And our declining balance rate is going to be 40%. So in year 1, the amount of depreciation expense for that year is going to equal the book value times the rate. Our accumulated depreciation at that point is going to be the same, 80,000, as our depreciation expense. And so our book value at the end of the year is going to be the original cost minus the accumulated depreciation. In year 2, our book value now to start the year is 120,000. The rate stays constant for declining balance. Oh, wait, I did that wrong, didn't I? What did we say the rate? We said it was 0.5.
50%. Yeah.
Sorry about that. Whoops. And again, we found that rate by taking 1 over the useful life, 1/4, which is 0.25, and then doubling it. So our rate would be,
So we don't, for the double straight line, we don't take the 200,000 minus 25,000 of salvage value?
no, we don't account for salvage value till the end. In that last year, we will depreciate enough to leave the book value at the salvage value.
Yeah, that's right. Okay.
So our accumulated depreciation at that point, and our book value at that point will be the original cost minus the accumulated depreciation. So the question was, I think it was,
It's
what
hidden
is,
behind your,
I have it now, what is the depreciation for 2014? Okay, so this was, the first year was 2013 and 2014. So what is the depreciation for 2014? So for 2014, our depreciation expense will be $50,000.
so it's not asking for accumulated, it's just asking for depreciation.
Yeah, I think that's, it's not a well-written question. They should say, what is the depreciation expense? Because it could leave someone to try to talk themselves into accumulated depreciation. But for one thing, our accumulated depreciation in 2014 isn't one of the available answers. But yeah, they're asking us what our depreciation expense in 2014 will be. So the only way to do this problem is to actually complete this little depreciation schedule for the first 2 years to figure out how much depreciation expense will be in the second year, 2014.
If I do, so if I do 200,000 times 1/4, that gives me 50,000.
Right. So
So
we doubled that.
But we double it for the declining.
Right.
But
So
but if I do 1/4, that isn't that? Oh, okay.
that's the straight line rate, 1/4.
So you have to double it for the declining balance method.
Okay.
It says at double the straight line rate. So if you know what that is, then you just double it.
But yeah, so 1/4 gave us the straight line rate.
No, but that wouldn't be the straight line because the straight line counts for salvage value. And if I do 200,000 times 1/4, that gives me 50,000.
Right.
But that's not the straight line.
Right. We're not doing straight line here.
No, but I'm not saying, I'm saying
So the straight line rate just means
200,000 times 1/4 is. Why am I getting the answer? That's the question that I have. Like, why am I getting the right answer just doing the full value, the full cost, not accounting for the salvage value times 1/4? Why am I getting 50,000?
Oh.
because in that case, the salvage value isn't going to factor in until the end. Okay. In other words, no matter what method we use, the asset will be worth its salvage value at the end either way. It's just the amount of depreciation we take each year getting there. And so it just happens to be in this case that taking 200,000 times 0.25 or times 1/4 is going to give you 50,000. Because if you think about it, we're doing 50% of the whole amount in the first year, and then 50% of half of that in the second year, which would be the same as 25% of the whole amount. So we're depreciating 75% of it by the end of the second year, which is the same as 50,000 left out of the 200,000. And so that was a lot of confusing explanation to say the only reason it works out is because it happens to work out with these numbers. This is using nice round numbers.
Okay.
Like that wouldn't be it wouldn't be the case every time.
Nice and round.
Okay, so I do have to do the work through.
Yeah, there's no way. That's not a shortcut that would work for you consistently.
Okay.
You're like, that's all I was asking is, do I find a shortcut? That'd be great. If you found a a solution.
Yeah.
I see 3 IFRS questions there. I do not remember that in the book.
Yeah, always get me too. The problem is I found it in the book, but like very little, like on a little hint at the end of the chapter. It's about that.
The IF.
Yes, talks about one of those 3.
Yeah. So IFRS is just the
I am
international
not
reporting
seeing it.
standard as opposed to the United States standard.
Right. I'm just looking at the end of the chapter trying to see where she saw it.
I can tell you the page.
Is there any other problems you wanted to look at?
No, it was just those 3.
Okay.
Just those 2. Yeah, those 3.
And so now that we've talked about them and I've made you more confused than you were at the beginning, I feel like I've really earned my money today. Sorry. Sometimes talking through it's confusing. Janice, did you have anything in particular that you wanted to look at?
I'm still working on the 9-3 in the second week.
I have a question about the extra credit work. Do we get that as we do it, or we are gonna get it at the end of the semester?
No, it should be being added in as I grade it and put a little 10 points on each one. You're like, dang it, I was hoping my grade was going to jump up at the end.
It doesn't change at all.
It's a very small amount.
I can tell.
Yeah, the max I'm allowed to give is like 2% of the whole overall grade. And so that means if somebody were to do every extra credit, it's enough to bump you up 2 percentage points, which is meaningful, right? It could be the difference between a B plus
right
and an A minus, or a B minus and a B, or a C plus and a, but it's not gonna, what they don't want is for us to give, I'm gonna mute that. What they don't want is for us to give so much extra credit that a student who doesn't understand the concepts can still do well and, can still get an A in the class or something.
Okay.
Anyway.
So the final exam is, how do we study that? I was checking, it doesn't have any additional like self-test.
Sorry for yelling.
I muted you. I didn't even hear you.
Oh, good.
I didn't hear you.
The door was
cursing at your teenager.
Mm-hmm. The door was unlocked. I'm like, someone has to be home. Okay, sorry.
No, roses bloom beneath our feet. All the world's a garden sweet, or something like that. Whoever wrote that probably only had like little tiny 2-year-olds when they wrote it, I think. Like, they're so adorable.
We're sure not like 6 months.
Anyway.
I don't know if 2 are adorable. Anyway.
I think they're adorable. My 3-year-old likes to like roast her dad all the time and tell him, like, if he tells a joke, she says, "You're not funny, Dad," and just deadpans it like that. And
well, that's a 3-year-old, not a 2-year-old.
Okay, that brings joy to the whole family. So Patricia, to answer your question, the final exam is a cumulative exam, meaning it's going to have, in essence, what it does is it pulls questions from each of the previous exams. Okay. And so, just to make you more afraid of it, that's how it's set up. And so honestly, the best way to prepare for it is those study guides for each of the chapters.
That's a lot.
I know. The best way would be if they would let you review the exams and you could, but they again, reiterated to us in a meeting this week the sort of the sanctity of the exams and only reviewing them one-on-one with students if they seek that, not to allow students to review the exams directly. Another a piece of bad news that I was gonna post out there, but I'll let you know in this meeting. My practice of allowing students to retake an exam, they told me this week that I was not supposed to be doing that ever, and that I was a bad person. Actually, they didn't say that. But so we're not allowed to give a retake. this year after I was hard as I already told people, oh, you'll be able to do a retake. And the accounting department is saying, no, you shouldn't have been doing that and you can't do that. So I want to apologize to you that I lied to you
I don't think I ever heard that we could do a retake.
Well, good, because you can't. So
I just assumed we couldn't.
yeah, I had. What's interesting is it had very small impact on people's overall grades. I think it was more like a hopeful thing, like, you know, they could raise their grade a little bit. And so I'd done that in previous years, and actually I was on a training video training other instructors, and had told them that, and they were like, awesome. And then one of our other instructors heard that and asked somebody, you should never ask. And they were like, no, they shouldn't be doing that. So so that killed that. Anyway.
All right. Well, okay.
So mine was the 9.3.
Okay, I can pull it up. Let's see. Whoops. Uh-oh. Let's see.
Line 3A.
I'm having some problems. Let's see, modules. When I try to pull up modules, it's telling me a page error, and I can't. Let me go home. That's still there. Week 10, homework, chapter 9, part 1. Oh wait, is 9.3a in homework part 2?
Mm-hmm.
Oh, well, okay. I just went to part 1.
No, I don't have any problem with part 1.
All right, 9.3 alpha. Let's see. Let me share my screen again.
There is a video on it, but I watched the video and I still had questions.
Okay.
So the first thing is the machinery. So retired. So I understand equipment, but I don't understand why it's accumulated depreciation up here.
Okay. So in essence, let's see. So on January 1st, we're recording the retirement of the machinery, right? So, and it tells us that the machinery, let's see. Has reached its useful life. So when the asset is fully depreciated, okay, and it has $0 in salvage value, that means that the cost account or the asset account equipment is going to be equal to the accumulated depreciation account for the equipment, right? Because we've now claimed as an expense through depreciation the whole cost of the asset over its life. So when we get rid of an asset,
so that's how you write off a retired asset.
Right, is
Go ahead.
we debit the accumulated depreciation account to bring it to 0, and then we credit the asset account to bring it to 0, and now the asset's off our books. So the journal entry to retire an asset when we're not selling it for any cash is just to debit the accumulated depreciation and credit the asset account.
Okay.
And let's see, on June 30th, when we sell the forklift, the first thing we have to do whenever we sell an asset is we have to bring the depreciation current up to the date of the sale. So the forklift has a 5-year useful life. The cost was $26,400, and it was purchased January 1st, 2014. So that means we would have depreciated it already. We would have done a depreciation entry on December 31st, 2014, December 31st, 2015, December 31st, 2016. And now on June 30th, 2017, we've got a recorded depreciation that's happened from January 1st, 2017 up to June 30th, 2017. And so these are,
that would be the cost divided by useful life and then times
right, because the forklift had 0 salvage value. So $26,400 was the cost. It has a 5-year useful life, so divided by 5 gives us $5,280 per year.
January
Through June 30th, so 6 months, right? January, February, March, April, May, June.
Okay.
So if that's 1 year, 5280, I divide that by 6 months or half a year. And so that's the depreciation entry I will put so that my depreciation is completely up to date at the time of sale.
So this is one where it needs 2 entries.
Yeah.
First, you have to update your depreciation.
Right. And then we can do this entry to actually record the sale. Now it's always the same when we record a sale, as we debit the amount of cash we're going to receive. Then we debit the accumulated depreciation account. We credit the equipment account to bring it to 0. And then we'll either have a gain or a loss on that, depending on if we brought in more than the book value or less in cash.
Wait, so where does the 10,560?
That's the amount of cash they sold it for.
Oh, did it say that?
Sorry about that. Yeah, so it says it right. My calculator's in the way, I think.
Yeah.
The forklift was sold for on June 30th for $10,560. So what I do for these transactions is I always debit the cash first. That's how much cash I got for selling the asset.
Okay.
Then I always debit the accumulated depreciation, which would be, like I said, we know this started January 1st, 2014. So we had 2014, 2015, 2016, 3 years of full depreciation plus the half year we just did. So that would be the balance of our accumulated depreciation account at the time of sale.
Okay, and the equipment is the original cost.
Oops. 26,400 divided by 5, and then so 18,480 would be the value or the balance of our accumulated depreciation account. So to bring that account to 0, we'll debit the account 18,480. Our equipment is that's the cost account, right? That's listed under the asset. And so now, before I do this gain line, what I would do is I would just say I need to make this whole transaction balance.
The debits and credits.
Right. So in this case, I had $2,640 that needed to be entered on the credit side here in order to make the whole thing balance. So if it's entered on the credit side, that's a revenue account, and it's going to be a gain. If to make it balance, I would have had to do a debit entry. That would be an expense account called loss on disposal of plant assets. So that's how I go about doing it. I enter the cash, I debit the accumulated depreciation and credit the asset, and then any difference, if it's on the debit side, I list as an expense called loss on disposal of plant assets. If the difference is on the credit side, then I list that as a revenue called gain on disposal of plant assets.
And you're not, when it's a loss, you're not subtracting it anywhere.
No, it'll just be a debit entry instead of a credit entry.
Okay. Okay.
And then the other asset, the truck. The truck was discarded. Poor truck. Okay.
Feel bad for it.
What's that?
I feel bad for the poor
Yeah,
truck.
exactly. So same thing, we have to bring the depreciation current,
Expense. Okay.
right? And so again, it would just be 1 year's worth of it. The truck had a salvage value of 2640. So if I say the cost was 29,392 less the residual or salvage value of 2640, and then divide that by its useful life of 8 years, that's the amount of depreciation I do for each year of the truck's life. Since
Okay.
I'm discarding it on December 31st, I'll go ahead and do a full year's worth of depreciation for this year, 2017. So that's the first entry to bring the depreciation expense up and the accumulated depreciation up to where it should be at the time of disposal.
Okay.
Again, there's no cash because we're just discarding it. So then, we didn't sell it for anything. So we have to
Right.
figure out the value of our accumulated depreciation account, which is to say, we know that we depreciated at a rate of 33.44 per year, and we purchased it January 1st, 2012. So we have 2012, 13, 14, 15, 16, and now we're getting rid of it 2017. So it's been in service 6 years.
Oh.
So 6 times 33.44 will be the balance of our accumulated depreciation account at this point.
Okay.
So we credit accumulated depreciation. We debit accumulated depreciation. We
And
credit
we lost 9,000.
equipment. And then the fact that there's a difference between those two and that we have to make that difference entry to make it all balance on the debit side means it was a loss. Whereas up here we had a difference between them and we had to make that entry on the credit side to make it balance. That means it was a gain.
So credit is a gain and a debit is a loss.
Yeah. Some people don't like to do it the way I do it. Instead, what they do is they say book value, they figure out the book value, and then from there, if they sold it for more than the book value, they'd show that as a gain. And if you sell it for less, in this case, we sold it for $0, so it's definitely less than the book value, they'd show that as a loss. Some people prefer to calculate it out that way.
I think that's what the self-study thing talked about.
I think so too.
Know your book value because it's
right. My way is just a shortcut, I think, or maybe someone who's been doing it a long time just says, hey, if there's a difference between the cash I receive and then the write down of the accumulated depreciation and the equipment, if that difference comes out on the debit side, it's always going to be a loss. And if that difference comes out on the credit side, that's always going to be a gain. And so that's just my shortcut because I've done it a lot of years, I think. But whatever works best for you if you want to calculate.
Well, I think this looks a little bit less confusing. Because once you have your equipment and your accumulated depreciation and your cash, you just have to make sure that they both add up, that they're both equal on both sides.
Right. And the way I remember
short.
Right. And the way I remember it is when I sell off an asset, I'm either going to take a loss, which is an expense, or get a gain, which is a revenue. And so revenues are recorded on the credit side. So if my difference is a credit side difference, then that's a revenue and it's the gain. And if my difference is a debit side difference, then that's an expense and that's a loss. That's how I remember it.
So let's see. So if it's a debit, it's an expense.
Mm-hmm. And the expense is called loss on disposal of plant assets.
Okay. I wish we had not that I want to continue another week, but I wish we could just have 2 chapters this week. And 2 chapters and then 2 chapters.
Anyway. Okay, well, I think we should probably end.
Yep. I
So
think we're the only ones still on here. I think.
I think Patricia's here, but
Oh, no,
Patricia's,
she's there.
yeah.
I see that there's 3 people
Yeah,
still.
I'm here.
Yep.
You're just very silent.
She's quiet. She had it muted. She mutes it unless she's
Okay.
going to talk. That way there's no background noise, like teenagers.
Yeah. Yeah, sorry.
Like I said, we didn't even hear it because I heard that you had that something going on, the knocking on the door. So I just muted it so that we wouldn't hear your personal business. So.
It was actually my returned missionary I sent for groceries, and he was pounding on the door and no one was going to answer it.
Do you ever
like,
expect that when they get
"What?"
home from a mission, they're somehow going to be perfect adults and then they sort of revert to being teenagers a little bit?
So far not too bad.
That's good.
Not too bad.
Ours are great too, actually,
But
and they're not around here enough, so I miss them. Anyway, so what? So I said the opening prayer. Can one of you be willing to say the closing prayer?
I'll say it.
Okay, terrific.
For a while. Our dear my Father, we're thankful for this time we've had to discuss these chapters that we're studying. We ask Thou bless us as we study, that when we take the exam that we can remember those things which we studied, and we're thankful for the opportunity to continue our education even with the health things going on around us. And we say these things in the name of Jesus Christ. Amen.
Amen. Thank you very much. Have a great night.
I'm like, if they cancel school, I still have school.
Exactly.
So go read a book.
I have 4 kids now in the house.
You have what?
I have four kids now.
I have 3.